Hello, Mr. and Mrs. Kemp. I wanted to first thank you for taking the time to meet with me to review your financial plan. I'm glad to hear you enjoyed your vacation to Europe, and I hope you can plan for many more now that you're in retirement. Congratulations on selling your marketing business, John. And Mary, congratulations on officially retiring from ShopRite. You both have worked hard, and it shows by the assets you both have accumulated. I understand that all of your family is in good health and that you have two children, Stephen and Robert. I also understand that you have three grandchildren, Michael, James, and Sarah. I have created a full detailed report of your financial plan, and together we will review the following subject areas: your financial health, risk management, investment planning, retirement planning, tax planning, and estate planning. The plan will then conclude with an action plan, which will identify action items that will need to be immediately addressed. A comprehensive review of your financial situation was conducted using the information you provided my firm. The following 5 goals were identified and prioritized. The first goal is to reduce any estate and gift tax liability and ensure all estate planning documents are in order. Your second goal is to review insurance contracts and discuss the implications of purchasing a long-term care policy. The third goal is to establish a college funding plan for the 3 grandchildren. Your fourth goal is to reduce personal income taxes. And your fifth goal is to recommend a diversified portfolio that meets your investment needs and risk tolerance. Speaking of your investment needs, it appears that you both are very willing to take investment risk and have the financial capacity that can sustain the above average risk. I also understand that it's very important to you to not invest in tobacco stocks, as both of your parents died from lung cancer. The one last area I would like to review with you before we jump into your plan are some economic assumptions. You are currently in the highest marginal tax bracket, and it's expected to be that way for the next 10 years due to an installment sale of your business. And the inflation rate is currently in future will be at 2.85%. The risk-free rate is expected to be 3%, and the market risk premium is expected to be 7%. As long as you're okay with those assumptions, we'll move forward into the plan. I have provided for you below the 6 sections that we will discuss. The first section of the financial plan is the summary of your financial health. You'll see that I've provided a statement of your financial position, which includes a ratio analysis and a statement of cash flow. Your balance sheet reports a net worth of $13,516,939. Your cash flow report shows a net disposable income of $1,568,834. Together, you have a sizable net worth and adequate disposable income that can be used in reaching your financial goals. When we look at your balance sheet, I would like to review a financial ratio known as the current ratio. Currently, your current ratio is 52.76, which is calculated looking at your current assets divided by your current liabilities. The typical ratio recommended is between 1 and 3. With the level 1, it shows that you can pay your short-term obligations. However, yours is so high that it does show that you may have a little too much cash on hand. And my concern is that you could be missing future growth opportunities. I would also like for you to recognize that the Federal Deposit Insurance Corporation, FDIC, insurance will only cover the first $250,000 per person per institution. It may be a good idea to separate these cash assets if that is something that concerns you. In terms of your total cash level, I would recommend maintaining a level of 6 to 12 months of living expenses. The remaining cash can then be transferred to one of your investment accounts to ensure that you're not missing out on future growth opportunities. Moving on from your cash portion of your balance sheet, I would like to discuss your two properties. Your primary residence has a fair market value of $940,000 and is debt-free. The vacation home you inherited from your father has a fair market value of $750,000 with a remaining principal mortgage balance of $19,292. Now, the mortgage on the vacation home does have a higher interest rate than what is currently available. However, you only have 33 payments left, and the majority of your payment is covering your principal at this point. So I would not recommend refinancing. Closing costs typically would deter you from that. I do see that there is credit card debt, and Mary, it's my understanding that you're going to pay that debt off when you receive the bill. I have a credit card. I try to keep a $0 balance. I do use my credit card for cashback rewards and flight miles. I do recommend you do the same, but continue to pay that off because you have plenty of assets that you don't need to pay the unneeded interest rates. Other than the high level of cash, your balance sheet and financial health looks very strong. You have very low levels of debt and when compared to your assets, and you also have income that is expected to last for 10 years that should cover most of your expenses. Now, I do know that one of the goals you listed for me to cover in the plan is a college funding planning strategy. I would recommend using a 529 plan and set one up for each of your grandchildren. 529 plans will grow tax deferred, and distributions are tax-free if used for qualified education expenses such as tuition, fees, books, supplies, and computers. 529 plans also offer flexibility and transferability should one of the grandchildren not go to college or technical school. To fund the 529 plans, you both can take advantage of the 5-year lump sum contribution. This will allow you to contribute $150,000 per grandchild or $75,000 each for a total of $450,000. I would like to mention that if you go this route, you will need to file Form 709, the United States Gift and Generational Skipping Transfer Tax Return. I would also like to point out that while 529 plans have some great advantages, they also have some downsides. Typically, 529s do offer limited investment choices relative to other investment accounts. And distributions for non-qualified education expenses will be taxed on the earnings portion of the account and will have a 10% penalty. We will want to try to avoid that. Flipping to the next section of your plan, we'll review the summary of risk management. Before I dive into that any further, I would like to disclose that the insurance agent that referred you to me will pay me $1,333 should you hire me. So first, I would like to look at your homeowner's policy for your primary residence. Unfortunately, your coverage does not cover 80% of your dwelling value. If you do not have 80% coverage, the insurance company will only reimburse you proportionally up to that 80% value. So we would want to increase your coverage to at least $620,000, which will cover the 80% of the $775,000 dwelling value. By increasing and maintaining your insurance coverage, you will eliminate a shortfall in coverage. Now, unlike your primary residence, your vacation home is adequately covered for the 80% coverage test. However, HO3 coverage does not typically cover events such as flood, earthquakes, and sewer backups. Considering you're very close to a river, any damage from a flood will not be covered. I would add the additional flood insurance. The next policy I reviewed is your auto policy. It looks like you're both covered, especially for standard damage claims. However, should a catastrophic accident happen, your current umbrella policy of $1 million is not sufficient. I would recommend increasing your umbrella policy to cover your net worth, or approximately $13 to $14 million. This makes sense because the premiums are minimal relative to the coverage provided, and I do recommend that. I also see that you went ahead and purchased Part B of Medicare. That's a great idea because it covers more than Part A alone. If you find that neither one of those is satisfying your requirements, I would look into additional Part C and D coverage. Part C is known as the Medicare Advantage Plan, and it'll cover all of the same benefits as A and B, but it'll do so with different rules, cost, and coverage limitations. Part D will assist you with prescription drugs. As you are both in your late 60s, I understand that you are concerned about the implications of buying a long-term care policy. I would in fact recommend buying a long-term care policy for both John and Mary. The policy is a comprehensive policy that allows each of you the right to share the other spouse's policy benefits. The benefit will be paid for 3 years or up to $360,000, whichever comes first. The annual premiums are $5,250 for John and $4,000 for Mary. I'm not sure if you're aware of this, but part of your premiums will be allowable as a medical deduction if you itemize your income taxes. John, you can deduct $4,350, and Mary, you can deduct your full $4,000 premium, which leaves a net disallowable premium of only $900. The last recommendation I would like to discuss is adding personal property endorsements for your 1918 inverted Jenny stamp, your personal property, and furniture. Currently, you have very limited coverage with the HO3 policy should anything happen to any of that personal property. We'd want to make sure that gets protected. In addition to the strengths and weaknesses of your insurance policies, a two-part analysis was included of John's annuity. The first part of the analysis was the tax consequences should John annuitize his policy. The second part of the analysis looked at the tax consequences should John gift the annuity to your granddaughter, Sarah. Now, assuming Mary will split this gift with you, John, the fair market value of the gift would be $37,000 to each of you. In addition, both of you can take your annual gift tax exclusion of $15,000, which leaves a net taxable gift of $22,000 each, or $44,000 combined. I would like to mention that it looks like this would qualify as a generational skipping tax. Even though Sarah's mother died, her father, Robert, is your direct lineage son. Therefore, Sarah would be considered a skip person. On the third section, I would like to review with you the summary of investment planning. An investment policy statement and an analysis of the investment portfolio was prepared for your review. Although you have $3,847,682 in non-qualified assets and $1,159,540 in qualified assets, the non-qualified assets are underperforming on a total risk basis. This can be shown by looking at the sharp analysis I prepared for you. In addition, there is a concern that the stock portfolio is not well diversified with only 4 stocks. And while the mutual fund portfolio is diversified, I do not believe that the allocation matches your risk tolerance, and there may be additional cheaper alternatives to accomplish your objectives. Lastly, the qualified accounts are not structured in a way to maximize the amount you could leave to your children, and I know that was one of your goals. I would suggest following these recommendations. First, diversify the stock portfolio. I would recommend selling stock A and using those losses to offset the gains associated selling down stocks B, C, and D. I would also like to add 12 additional stocks to make the stock portfolio 15 total stocks. While this will not eliminate individual stock risks, it will reduce the risk and help diversify the portfolio. I would utilize this strategy because you have historically invested in individual stocks. Second, I would recommend we do a more detailed analysis of your mutual fund portfolio. I don't see any fund ratings listed, and I would want to make sure that these mutual funds are the best available to you. The evaluation process would compare fund ratings and performance, but I would also take into consideration tax consequences should a better performing mutual fund be available. We would not want to sell a mutual fund for a small annual fee decrease if there's a large taxable gain. This portion of the analysis would also include an evaluation to determine if an exchange traded fund or an ETF would serve as a better alternative investment over these mutual funds. ETFs are a type of security that involves a collection of securities, such as stocks, that tracks an underlying index. Now, ETFs are similar to mutual funds. However, they trade as like a stock on exchanges, and shares are traded throughout the day. Using ETFs would be a good alternative because typically the annual fund expenses are cheaper. And with our custodian, ETFs do not have a trade commission. Since you will be adding additional money from installment payments, that's another fee that we can help reduce or eliminate. My third recommendation would be to fix your overall asset allocation. Currently, you have a large exposure to international equities. It's 38% of your mutual fund portfolio or 29% of your non-qualified assets. I would reduce the international exposure to around 10 to 15%, and I would increase your bond allocation. Now, the increase in the bond allocation would depend on the diversification of the balance fund, but I would try to keep your non-qualified portfolio around a 70-30 allocation. I believe that fits your current risk tolerance, your ability to take risk, and accomplishes your investment objectives. My fourth recommendation would be to evaluate using tax-free municipal bonds. You are currently in the highest marginal tax bracket, and municipal bonds are exempt from federal and state taxes for residents of the issuing state. Before automatically investing in the municipal bonds, however, I would like to compare the available municipal bonds against the available taxable bonds. This comparison would involve a calculation that would compare the tax-adjusted yield versus the yield currently available for the taxable bonds. If the tax-adjusted yield is greater, we would use municipal bonds. Saying all of that, however, I would like to mention that municipal bond income could be subject to the Federal Alternative Minimum Tax, also known as AMT. I would like to check with your CPA or a potential CPA if you do not have one to make sure that these bonds make the most sense for you. Finally, I would like to discuss your qualified accounts. You said you would like to distribute the maximum left in the accounts to your children upon death. Since it appears these accounts should not be required to sustain your lifestyle in retirement, these portfolios can take more risk. I would recommend an 80-20 portfolio for these two accounts, and the portfolios would be constructed with exposure to growth stock funds, the S&P 500 index, international equity, and low duration bonds as interest rates are expected to increase. If you accept these investment planning recommendations, using the asset allocation strategy for your portfolio will maximize returns in a tax efficient manner. I also believe you will be more diversified, and this total strategy will match your above average risk tolerance level. If you flip to the fourth section, I would like to review with you the summary of retirement planning. You have already entered retirement and currently have $10,875,938 that can be used to fund your retirement. Now, that does not include your personal use assets. And additionally, your cash inflows and cash outflows I reviewed with you earlier. It's clear to me that you have accumulated enough assets to sustain your current retirement lifestyle. Now, one of the goals you discussed with me is that you would like to distribute the maximum amount from your 401k to your children. While I didn't address the investment strategy I would use earlier, I would also like to discuss the idea of converting the 401ks to Roth IRAs. Roth IRAs will grow tax-free as opposed to a rollover IRA, which will grow tax-deferred. Roth IRAs also do not require minimum distributions, which means that the money can stay in the account without being withdrawn, which is different than IRAs. Now, while Roth IRAs are a great solution for growing assets tax-free, It's not an easy decision, and I will lay out 5 reasons and factors that we should look at together. Currently, you're in the highest marginal tax bracket. You listed 44%. So should you decide to convert the accounts to a Roth IRA, you'd have to pay approximately $510,000 in taxes. While you could use your savings account to pay for that tax liability, it's still a substantial tax bill. Some questions to think about is, what's going to be your future tax bracket after the installment payments have completed? Or will the government change tax rates in the future? If your tax rate's lower in the future, the conversion would make complete sense during those years. The third factor has to do with your beneficiaries or your needed access to the funds. If you need access to the funds within 5 years, the earnings are taxable because of the 5-year Roth IRA rule. So we'd want to take that into consideration. The fourth factor is, what are future growth rates going to be? If growth rates are low, it will take longer to make up the time and make up for the cost of those taxes you've paid. The fifth factor is, what is your children's tax bracket going to be? If you die while they're in a low tax bracket, the tax implications of the withdrawals from the IRA would be much lower. Again, that's a factor you would want to consider. All of the above factors should be used in determining if you would like the assets to grow tax-free or tax-deferred. I personally would recommend letting the assets continue to grow tax-deferred because you are in the highest marginal tax bracket currently. But that will ultimately have to be a decision you make on your own. If you believe that the assets in the Roth IRA will grow by enough to offset the tax liability, especially using the investment strategy I outlined for you earlier, the Roth IRA conversion will be a great strategy for you and your children. I would also like to inform you that even after you do a rollover into either the IRA or complete the Roth IRA conversion, you cannot contribute to any IRA, including a Roth or non-deductible IRA, because you are not currently have any earned income. Lastly, I would like to discuss qualified charitable distributions, which are known as QCDs. They've become a very popular discussion with clients, especially when satisfying the required minimum distribution. Now, I know you're not at the age for required minimum distributions, and currently the money is in the 401k accounts, and those do not qualify for QCDs. However, I do think this is something you would use in future years, and I would like to revisit QCDs in 2 or 3 years. The next and fifth section of the plan is the summary of income tax planning. I have provided 3 tax calculations and they are attached for you. The first calculation I would like to review with you involves the sale of your business. You sold your business in February for $6 million. The terms of the agreement are a 20% down payment to you with a 10-year quarterly paid 4.5% note on the remaining balance. You had a tax basis of $1.45 million in the business, so a portion of the down payment and each future payment will be deemed a return of basis. To calculate the return of basis, the exclusion ratio must be calculated first. The exclusion ratio is calculated by dividing the adjusted basis by the sales price. Your exclusion ratio, as I've shown, is 24.17%. Using that exclusion ratio, we can now determine how the down payment and quarterly payments will be taxed to you. The 20% down payment was $1.2 million. Using the exclusion ratio, that shows $290,000 of that will be deemed as a return of basis. The difference of $910,000 will be taxed to you at your long-term capital gains rate. A benefit to this tax rate is that it is much lower than your marginal tax rate of 44%. I would also like to look at your quarterly payments, and I attached the calculations to your financial plan. Your quarterly payments are $149,681. Now, a portion of that payment is going to be interest, and part of that payment is going to be principal. The interest received will be taxed at your marginal tax rate and will decrease over the life of the note. The principal payment you receive will continue to increase over the term of the note. I have attached a breakdown of your first payment. Your first payment will consist of $54,000 in interest and a principal payment reduction of $95,681. When you take into consideration a return of basis using the exclusion ratio of 23,123, that gives you a net realized long-term capital gain of $72,558. Again, the capital gains rate is lower than your marginal rate. The second calculation performed for you was if you sold your building for $1 million. As you will see in the attached calculation, there are going to be two separate gains from the sale. The first gain is known as a 1250 gain. A 1250 gain is an income tax provision that will recapture the depreciation that was previously deducted from the real property. The 1250 gain is taxed at 25%, which is a lower rate than your current marginal tax rate. The second gain, as I've shown in the calculation, is known as the 1231 gain. Since the property was held for longer than a year, that 1231 gain will be taxed at your capital gains rate, or 20%. The third and final tax calculation was involving your 1918 inverted Jenny stamp. The calculation was hypothetical for selling in 10 years. I know the stamp was stepped up at your father's death and the cost basis was then transferred to you when your mother gifted it to you. If we take out the commission as well as the tax basis from the stamp, you were left with a realized gain of $817,500. Since the inverted stamp is considered a collectible, the collectible tax rate of 28% will be used, and the resulting federal tax liability is $228,900. The last and sixth section of the plan revolves estate planning. I have provided you a property ownership spreadsheet and estate tax calculations for both of you. Currently, neither spouse has an estate that is subject to estate taxes if either one of you was to die this year. However, a significant problem is that each estate, especially John's, is subject to excessive probate fees and expenses. Additionally, there are assets that are currently going through probate because of account titling and beneficiary designations, and these assets could avoid probate with a few changes, as I will recommend. I also see no essential estate planning documents in place for either of you, such as power of attorneys and healthcare proxies. These would be used to manage your affairs if either of you were to become incapacitated. Lastly, it looks like John's life insurance policy was transferred into the ILIT within the last 3 years. This means that until the assets have been in the ILIT for more than 3 years, the life insurance proceeds will be included in his gross estate. Saying all of that, I would like to give a few recommendations. The first recommendation is to change the titling for the following assets from sole ownership to tenancy by entirety to avoid probate costs. These title changes would automatically transfer the properties to the surviving spouse at the first spouse's death. This property includes the certificates of deposit, the mutual fund portfolio, the vacation home, both vehicles, the boat, and the 1918 inverted Jenny stamp. Second, I would change the beneficiaries of both 401k accounts. Instead of listing the beneficiaries as your estate, I would list each other as the beneficiary. Currently, listing as the estate will pass these assets through probate. If you list each other, these assets would instead pass by contract and avoid probate. My third recommendation is to visit with an estate planning attorney to obtain powers of attorney, healthcare proxies, and discuss how a trust can assist with passing your assets to your children. Changing the account titles that we just discussed is helpful should something happen to you individually. However, if something tragic happens to both of you, there will be future probate and estate issues. I would discuss the idea of using bypass trust and power of appointment trust to assist with passing down assets to your children and grandchildren. The costs for implementing these recommendations include changing property titles and attorney fees and are approximately $10,000. You could pay for that expense using your savings account. So we've reviewed all 6 portions of your financial plan, but before I leave you, I would like to give you an action plan that consists of 5 items that need to be specifically addressed and have immediate attention. I believe if you complete all of these, they'll help improve your financial position. The first item is to visit with the estate planning attorney as soon as possible. I just mentioned the importance of having all of those documents in order, and I think that was the first goal you identified for the plan. The attorney can assist you with implementing all of the estate recommendations I recommended, and I really think you should meet with them this week. If you don't have one, I can help get you into connection with a qualified, representable estate attorney. My second recommendation, an action item for you, is to change property titles from sole ownership to tenancy by entirety to avoid probate. During this step, I would also recommend changing the beneficiary designations on both of your 401k accounts. The third action item is to increase your insurance coverages that we discussed earlier. That includes increasing the HO3 coverage on your primary residence to at least $620,000. I would also add flood insurance to your vacation property. I would add additional umbrella insurance to cover catastrophic events. I would add personal property endorsements for your 1918 inverted Jenny stamp, personal property and furniture. And lastly, add the long-term care policy that we reviewed with the shared benefit rider. Adding all of this additional coverage will help accomplish your second goal of your plan. The fourth action item involves changes to your investments. I would diversify your individual stocks by using a tax loss harvesting strategy. I would fix your asset allocation. I would also evaluate using municipal bonds over taxable bonds. And I would evaluate the 401k to Roth IRA conversion. I can assist you with these changes, and I do believe making these changes will help you with your fifth goal of the plan. Lastly, I would open 529 plans for each of your grandchildren and use the 5-year rule to fund these accounts. This will help accomplish your third goal of the plan, which is to establish a college funding plan. I believe making all of these changes will help you accomplish all of your goals. I also believe it's important to review the financial plan as often as possible to make sure that your personal situation has not changed, as well as the ever-changing federal regulations do not have an impact on your plan's success. Overall, I do think you'll be very successful by making these few action items. And please let me know if you have any questions. Thank you.